Hello, ladies and gentlemen. Welcome to this panel on Digital Exchange 4.0, centralized versus decentralized. My name is Hiranda Misra. I'm your moderator for this panel discussion, and I have with me some great panelists today across the digital assets ecosystem. We'll start with briefly having them introduce themselves and their kind of take on this area before we head into questions. So we'll start with you, Alex. And you're on mute.
It's the usual unmute button. Hi, pleasure. Thank you so much.
Someone's got to do it.
Got to be done. Exactly that. So Alex Batlin, founder and CEO of Trustology. Trustology is a custodial wallet provider for institutional clients. So we serve service providers like brokers, exchanges, and payment providers. We serve institutional investors such as hedge funds and the new DeFi yield funds. And we're also addressing the needs of token issuers. And we're starting to get a trickle of corporates who are looking for a little bit of exposure to crypto as well. So very strong on making sure that we manage keys for kind of organizations and transactions. We do so at scale and high performance. We are on the temporary register with FCA. We're also insured, so full service solution. And we're also very strong on DeFi, big area now with kind of all the various different decentralized protocols for hedging, lending, borrowing. We support all those transactions for any asset on Ethereum. So, and of course, we also integrate with centralized services like exchanges and clearing houses and ECNs. So, pleasure to be here. Thank you.
Great, welcome. And over to you, Arshad.
Hey, hi Hirinder, how are you and how are the panelists? I'm Arshad Khan, I'm the founder and CEO of Arabian Bourse. We are going to be the first regulated exchange in this region to offer trading in crypto assets as well as provide custodial services. So looking forward to good discussions in this panel today.
Great, and Mike, over to you.
Hi there, everyone. So I'm Mike Kessler, CEO of Tokenize, which is an international exchange and network. So we have a securities trading system over in Barbados in the Caribbean, but we're also FCA regulated as a broker over here in the UK, and we're talking to various jurisdictions around the world about becoming regulated. So looking at how we can offer a true international tokenized securities exchange for alternative assets and helping more to do with the kind of SME market and bringing financial inclusion to capital markets.
Great, and last but not least, over to you, Sean.
Thanks, Andy. My name is Sean Kiernan, the CEO of GreenGage, which is a startup digital merchant bank. We're currently applying for a full banking license in the UK and Gibraltar. As of today, we help to facilitate loans against crypto assets. We've done approaching 200 million of volume. And like Alex, we're on the FCA temporary register for crypto assets and monitoring regime.
Great, and since December, actually, I mean, we've seen the price of Bitcoin skyrocket, but that's had a positive knock-on effect with I think digital asset markets as a whole. I mean, there seems to be a plethora of announcements pretty much every day from large institutions on the asset management side taking exposure, and then the sell side increasingly coming in terms of services, and obviously even on the consumer side as well, with the likes of PayPal and Curve and obviously Coinbase as an acquisition, with institutional trading. So I guess my question to all of you is, and starting with Alex, I mean, how is digitization taking hold in the world of exchange trading and capital markets? And obviously, as it's moving so fast, I mean, how can participants make sure they stay ahead of the curve, given it is changing so much, and first mover advantage isn't always an advantage, really, as we know? And you're on mute again, Alex.
Someone's got to invent one of those things where it just knows when you're screaming at your kids or talking on a panel.
Artificial intelligence with blockchain, there you go. Answers on a postcard from the audience, please.
Awesome. Yeah, so I think, look, we've seen kind of an interesting evolution in digital assets. First of all, the whole Bitcoin phenomenon started with direct market access participation. You know, if you kind of zoom out, previously most assets were intermediated, and whether it's e-money, whatever. So we saw centralized exchanges like Coinbase coming along, doing extremely well, and Binance, and offering effectively direct market access to the exchange. So centralized intermediary minus the broker to effectively digital assets, and providing their on-ramp and off-ramp across fiat. And that lasted for quite a while because essentially most people didn't have access to crypto and needed a fiat on-ramp. Then we started to see evolution. You know, I think Binance Chain was one of the first to realize the movement to decentralized exchanges. And they introduced Binance Chain, which was optimized for atomic swaps and trading. And that kind of is moving along. And then came a number of decentralized exchanges like Uniswap. A lot of those did not follow the usual pattern of order matching. They are kind of based on liquidity pools and automated market making capabilities. So you have a kind of algorithmic determination of price. Essentially, the more you buy, the more expensive it gets. And it gives you this almost infinite elasticity of liquidity to some extent. Really interesting models. And actually, we're starting to see, for instance, a lot of that movement into decentralized exchanges. Uniswap took over Coinbase by volume in December for the first time, I believe. So, you know, some people will be skeptical and will think that centralized exchanges are here to stay, and maybe they will, or maybe they won't. We'll see how that goes. And then, of course, the next evolution is
actually just on that. Sorry to interrupt. You know, I'm going to give Arshad a chance to get into that point. You know, just before we expand on it, because obviously he's launching a centralized exchange, but obviously with digital custody. You know, again, integral to that. So Arshad, I mean, centralized versus decentralized in the debate. You know, obviously Alex suggests the volumes are going decentralized, but obviously isn't that a contradiction in terms, given you know the essence of an exchange is to centralize liquidity, even though we know with smart contracts and decentralized that's also possible. So your thoughts on that before we head into those other points?
Sure. In the last 20 years, if we see, there has been significant changes in the way trading has been happening, whether it is traditional assets or the digital assets of late. So what we have seen in the last couple of years, especially the way the digital assets or digital exchanges have come up and broken the boundaries of the traditional asset class exchanges that used to operate on a limited number of days or limited number of time in a particular day. And those things have been addressed by digital exchanges coming on board, offering 24/7 trading and real-time settlement and connecting issuers and traders directly. So taking away the intermediary cost and time along with that. So of course, now another form of exchange mechanism that is coming in place and getting a fair amount of visibility is decentralized exchanges, which in a way is a bit different than the way the centralized exchanges used to operate or the fundamental business nature that they have. But again, I come back to my own assumptions or my own perception in this area, where if we relate the issues that are very closely linked to digital assets, especially when it comes to financial crime or conducting the KYC, or having security issues in the system. So I think there the centralized exchanges have a better business model in terms of protecting the investors at the end of the day and conducting a more comprehensive KYC. And at the same time, when we bring a custody or clearing corporation in between, so someone who is acting as a central counterparty to a trade between buyer and seller, that gives an upper hand, or I would say an edge, to the centralized exchange business model. So I of course agree with Alex that both these exchanges have been very fairly new in the financial world, and the coming time in the next few years will really dictate where the trend is going. But I think to address the issues that the cryptocurrencies has always been aligned with, I think the centralized exchanges have an edge.
And they're just, I mean, Sean, because you're on the you look at the borrowing and lending side of crypto assets as well, and to me, when I sit here, actually the two aren't necessarily mutually exclusive, decentralized and centralized, because increasingly as well, I know B2B on the decentralized finance side is kind of a nascent market, but we're seeing interfaces, let's say from our technology into DeFi constructs, even from a centralized exchange model, to allow you to offer those services to your clients without actually going down the completely decentralized exchange route. So, what's your take on that level of intersection? I think
I completely agree. I think it's going to be a story of both kind of coming together and different bits of the puzzle using both centralized and decentralized. I think one of the interesting things, as you mentioned, is the rise of lending in the DeFi space, which has been an absolute kind of growth story in the last year, where now billions are passing hands completely out of any centralized balance sheet, purely peer-to-peer. I think the issue, though, for real institutional flows of funds, and particularly some of the big names I'm sure we'll speak about later in this panel, is that for them to engage in the likes of DeFi, it needs to be clean, meaning full KYC, AML. And as of today, there is no framework as yet, or a jurisdiction where there's a regulatory blessing for this element of DeFi to be brought into the fold. And I think if that can happen, if DeFi can be made to be normalized, if you will, and comply with the same standards that the centralized exchanges operate within, Arabian Voice, for example, is to a very high standard, I'm sure. That might be a way that those two worlds can speak, but I think that's still a story to be told.
And actually, Mike, I mean, this touches on an interesting point because, with what you're doing, really, I mean, exchanges have traditionally been B2B, at least the established ones. And now, you have a B2B construct, but you're also dealing with potentially direct clients, having access to a multitude of asset classes. Obviously, with that comes a different level of KYC ML challenge as well. So, what's your take on this? And, what are the challenges you found as you're a market operator, that's got live licenses moving ahead?
So we're kind of B2B to C, but we control most of the chain within that. So we still have to have a brokerage license in order to interact with the exchange. But the brokerage obviously can interact with those customers. So I think in terms of onboarding customers, I think the world is getting smaller in some ways, but more spaced apart in others. So I think in terms of KYC and AML checks and all the sanctions and PEPs checks, that's pretty much the same the world over. I think the difficulty really comes as to how you can do these things on a 24/7 basis, because if you want financial inclusion from different places throughout the northern and southern hemisphere, then we've got to be able to cater for that. And I think it's having different standards, having different kind of methodologies, dealing with those that are banked, potentially also not excluding those that are unbanked. So how we go about getting an international standard, I think is going to be the holy grail. I don't think it will ever happen. I think also what we have to bear in mind is that each jurisdiction has their own anomalies. So what the accredited investor is in the US and what they can invest in and their holding periods and things like that might be completely different to what it is in the UK or Uganda or Singapore or wherever these places might be. So there's no one global definition. So unfortunately, but I do think technology can assist with this, because technology effectively, if you can put in all the right parameters and create the matrix that people can fit into, then you can onboard customers and make sure that what they're doing is appropriate to the risk or commensurate with the risk that they can undertake within that jurisdiction.
And it's a good point. And Alex, just to touch upon, what you were saying. I mean, I know, again, with our interactions, regulation's been front of your mind, and you place a big emphasis on security, and you're dealing with the nuances of multiple OTC clients, exchanges that you're dealing with, and they're all in different jurisdictions. So how do you manage that? And some of that's challenging as well, because you're right. Whether it's in certain jurisdictions where there is no insolvency law for crypto assets, on the other hand, regulation is very markedly different, or in some cases non-existent. So how do you address that using technology?
Yeah, absolutely. I think we have so much experience from the centralized world, and it's always very tempting to bring that into crypto. But actually, I think it's a fundamental mistake, because the technology allows us to invert the control. The entire centralized system before was based on parameter controls, be that banks, brokers, and stuff like that. So because the money that being moved around is dumb, there's no, the piece of paper is not going to tell you that you're not allowed to hand me over. With digital assets that are based on smart contracts, you can invert the control. You can put the kind of controls around who's sending, who's receiving into the asset itself. Therefore, you no longer need to create controls around the parameter, the brokers, the other intermediaries. You actually include the controls in the asset itself. And this is some of the stuff we're starting to work through. So you can wrap Ether or ERC20 tokens into ERC777 tokens. The ERC777 tokens can have both kind of pre-send and pre-accept hooks. At this point, you can include an identity provider, and therefore you satisfy the FATF travel rule with a single standard that's actually, sorry, I've been in banks for a long time. 5 years later, people talk and talk about international standards. It doesn't ever frigging happen. It's a talking shop for people who don't bother getting into technology. Once you get into the technology, practical stuff, you include an identity resolution provider for the send-in, for the receiver. The two operators exchange the required data and confirm the transaction. So you can create wrapped tokens that are compliant on top of the non-compliant tokens, mixing the best of both worlds. So I do think I'm afraid I kind of always see this institutional conversations that just focus on why you can't do stuff and why everything's difficult, blah, 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 blah. It's not, it can be done. And actually, if you just understand the tech, you can have amazing solutions. And that's kind of the stuff we're working on. So I do think we need to break out of the mold that it's all complicated. It is, but you can solve that, and you solve it in new ways. Because if you solve in the old way, you simply end up with exactly the same cost and risk base as before, and there's no point in flipping to digital assets. So yeah, let's start thinking a bit broader, please.
This is interesting, because Sean, I mean, obviously you're going for various banking licenses, but with that, recently, and we know that a lot of the major banks are working on digital asset offerings, but then you hear time and time again, even in the UK, we're not just talking, in jurisdictions like Mauritius and elsewhere, or where we're operating, but you hear time and time again that crypto businesses aren't necessarily being banked, or accounts are being cut off. And when I've had dialogue with compliance teams, or account onboarding, and with some banks, the compliance teams at the moment just aren't with the program, if you see what I mean, because they really don't look at risk from a level of equivalence. And as soon as they hear the word crypto, it doesn't matter what it is, even if you're just dealing with the fiat with them, there's alarm bells ringing, as opposed to trying to genuinely solve the problem. So, how do you see that? And to be fair, some of the digital banks that have either launched or come into being, they don't fundamentally necessarily change the model, that's existed. But, how do you see that, and where are you positioning that as well?
It's a really interesting question. I think it gets to the nub of what Alex was saying. Where does the liability lie for taking these kind of innovative decisions and engaging with the new technologies? I think, in terms of our own journey and understanding the banking services for crypto asset clients or crypto transactions, we see the blockchain as a completely revolutionary factor because it makes the transactions much more public and decipherable than it would be if it were just traditional fiat, which is point to point. We can see the whole network on the public blockchains of who everyone deals with, which I think is gradually settling in as people get their heads around what this technology allows in terms of transparency for seeing counterparties to transactions. And I think compliance teams and banks, understandably, if there's a new thing that they don't completely understand, will wait until the market takes an action for them to move, and allows a space for new entrants like us to maybe get there a little bit faster. I think the question on liability, and this is the tech versus kind of where can you point a finger if something goes wrong, is what the regulators are grappling with right now. And I can't speak to any of them particularly, but as a general kind of perception, I think that the theology or the thoughtfulness of tech is that we can solve everything, except ultimately, if there is a flow of fund transaction, which for whatever reason broke the code, regulators want to be able to point a finger at someone and say, this is something wrong that needs to be made right. And so what we're hearing is that, and these are kind of not yet public discussions necessarily, that some discussions are aiming maybe to look at the companies writing the code, or what Europe is doing with MiCA is bringing the code into the regulated space by default, saying anybody that touches money has to be regulated.
Yeah, and this is interesting, Arshad, because again, with our interactions over the last few years, FSRA, ADGM, they've come up with a really good set of regulations. What I found was that there were a plethora of kind of provisional approvals or approvals for various kind of crypto asset venue plays. But I think, from where I sat, I found out that, the banking was almost an afterthought, even though that is now being addressed. So, how do you see that? Because of course, for exchanges to succeed, you need the ecosystem to digitize and a plethora of approvals, whether it's digital broking, prime brokerage, banking. How's it playing out in your region?
Yeah, that's a good point, and that's the ecosystem that ADGM has been instrumental in establishing. Of course, they began with more on the crypto asset businesses when this whole regulatory framework was being designed, and then they expanded themselves to include the digital banking as well as the other ecosystem partners like the ETFs or the intermediaries. So that has been the lookout. But if you look at this ecosystem from a one jurisdiction perspective, there the main problem comes, because there has to be a lot of hand-holding and a lot of integration between the various jurisdictions when we try to bring the other ecosystem partners, especially the banks, in this play. So that is some of the challenges that we have been facing from the traditional financial services institutions, because they are not limited to their one country jurisdiction. They're also exposed to a lot of jurisdictions or a lot of regulatory requirements that come in from cross-border, and with issues like correspondent banking, the SWIFT network, and things like that. So the moment there is a link between a bank and a crypto-related business, these peripheral service providers start having some kind of dialogues with the banking service providers. So we have been noticing these kind of issues that has been a bit of a hurdle in terms of how this kind of ecosystem can be really rolled out, how quickly and how smoothly.
And this is certainly interesting because, obviously their UAE is interesting because, recently Dubai also announced that in the next couple of years, they're going to have their own crypto asset framework. Obviously there are things happening in Bahrain, but I guess, again, you're going to end up with a multitude of frameworks, albeit I guess you're pretty used to that given those types of frameworks already existing, whether it's on the derivatives and securities side as well. But Mike, I mean, this, obviously you mentioned you're regulated in Barbados, and they're obviously smaller nation. Is it easier to implement new regulation? Is there a level of agility, or do you see some of the same challenges that our colleagues are seeing? You're on mute, Mike.
There we go. Sorry. I think, yeah, I'm just copying Alex.
It's a trend. It's catching on.
Exactly. I think in terms of, are they more open and approachable? Yes. In terms of changing legislation and regulation, I think that potentially, maybe they're more open to it than some of the larger kind of institutions like the FCA, because, but I would say that they've got greater challenges insofar as they're less developed in terms of their regulations. So someone like the FCA is fairly au fait. I'm not saying that everything that they do is perfect, far from it, but I think in terms of their understanding of the regulations and the legislation, that works quite well. Whereas a small nation like Barbados, it has a fairly limited Securities Act. So it's open to greater interpretation. And I certainly think that in terms of that, if you can get legal comfort with the nation, then it makes life easier. But at the same time, we've also been invited to apply to the regulatory sandbox, say in Mexico, which has a fairly robust new fintech law. But they're also looking at how they can adjust some of the regulations to fit what the new technology is developing. Because I think all regulators would admit that they're always behind the curve. So you have the innovators of the technology who go ahead and do something, and then they have to play catch up and make the regulations fit around that business model or whatever it ends up being. So I would say, yes, they are more capable of doing it, but everything goes fairly slow in the Caribbean as well.
Yeah, no, I mean, it's certainly interesting. I mean, it's our experience of smaller jurisdictions as well, albeit, Sean, I guess from your perspective, Gibraltar, you mentioned Gibraltar. I mean, what's your experience been with Gibraltar itself, vis-a-vis the UK, out of interest?
I think Gibraltar is a fascinating jurisdiction in that it has a very robust infrastructure to begin with, and they've had to, as some of the other jurisdictions we've mentioned, look to innovation to stay at the fore of the market. I think one thing that we've taken a lot of comfort from is that they've not just approved everyone. It's been quite a small list of firms that they've looked to attract, but they are definitely seeking to build a long-term presence there. I think they were one of the first countries to have a bespoke regime for crypto assets. And one thing that I think this contrasts with potentially to the likes of say Malta, which has been very vocal in establishing itself as crypto island, is that it sits outside of the EU, in which case the MiCA framework that's now coming into place, it still has a little bit of bandwidth to differentiate in Gibraltar. In places like Barbados, etc., I think there is that freedom still to look outside, although increasingly FATF and the travel rule, I think, will apply to everyone. So that is a positive, at least for setting a baseline for common regulatory oversight.
Yeah, and I think that resonates with me. I mean, given the activity on the GMX group side we've been having in Seychelles, Mauritius as well, but certainly, they're all looking at international standards. I mean, there are no IOSCO guidelines. I mean, there's kind of guidelines, but there's no principles formally published for crypto assets either. But increasingly now, as we deal with the regulators, they're kind of asking us to kind of demonstrate how we would comply. Although it's a bit strange because the existing Securities Act doesn't mandate that anyway. So we're in this period where that does allow a level of interpretation, as all of you said, but also, I guess, a level of innovation. And the challenge is always we're trying to loop that back to the regulators to then, give them that feedback loop and try and affect some level of policy or regulatory change, which, as Mike, you said, always takes some time. But just touching upon what I said at the beginning about Bitcoin and the interest there, all the talk generally is about that as a crypto asset and interest in it, with various fund announcements and exposure and then more recently Tesla amongst others. Obviously on the security token side, I mean, there's a multitude of protocols, but when we're technically enabling it, a lot of the demand is some form of Ethereum token or wrapper, as Alex said. I mean, beyond that, and this is an open question, to all of you. I mean, what demand do you see, in other crypto assets or other protocols for things like security tokens as well? So I don't know who wants to jump in. Yeah.
I mean, so I'll jump in if no one else is at the moment. I think in terms of different protocols, I don't think that we've yet seen the security token protocol of choice. I think it's going to be an evolving process. I think things like what one needs to bear in mind is things like Ethereum, as good as it is, because the recent price hikes and things like gas fees, it makes it incredibly expensive to be a financially inclusive system if you're doing everything on the Ethereum network. So I think you're also going to have certain security protocols that have to be built into these things. So I think over time, what you're going to see is a security token or a security blockchain evolve that is going to become an industry standard. Whether that's someone like Polymath, Securitize, Polymesh, whoever these things end up being, I think that still remains to be seen. But I think what needs to happen is one needs to be able to transact very, very cheaply, very quickly. And I don't think necessarily, I mean, as you know yourself, Hiranda, you don't necessarily need to do everything on the blockchain itself. So a lot of these activities will take place off chain, and then the recording of that activity will then go on chain to make sure that you've got that immutable ledger of what's happened. So I think that there's going to be a kind of thing over time where you'll get someone like NASDAQ will come up with some security token, probably protocol, and the LSE might, who knows? But I think the interchangeability of those tokens is also going to be key for the future as well, as to how that operates across different exchanges.
And this is interesting because obviously now all of a sudden, I mean, we've been used to traditional infrastructure evolving over decades. You mentioned Swift earlier, and a multitude of other infrastructure, fix on the order routing side. But now you've got multiple things happening on multiple blockchains. And obviously, people do talk about interoperability, but as you know, Alex, it's an atomic problem more than anything else. Now, and then obviously equally, depending on the custodians we talk to, the innovative neo ones like you, and then there's some of the more traditional ones coming in as well. But those that settle on chain and off chain, there's a differing standard in terms of how they do things. So how do we get a level of sense, and how do we use technology to knit together what's essentially now fragmented and more complex than it ever was, in my view?
Yeah, it is, but I think there's some really interesting developments. And again, I come from the technology background, but I think it's also important to know that I think there are legal and regulatory solutions for all of that. But this is ultimately a technology-driven space. So you need to look at the fundamentals of the technology and then apply everything else, commercial and stuff like that, to make it work. So the biggest development we've seen so far right now in terms of scaling is probably layer 2 protocols like Optimism, something that Vitalik's been very keen on. The reason I think that has a lot of legs is because it's compatible with the Ethereum virtual machine. So that whole army of people who have created this huge now number of smart contracts and protocols can very quickly and easily port that code from layer 1 to layer 2. So all of a sudden, you now have a very quick migration path to something that's a lot faster and cheaper than layer 1. So layer 1, the normal Ethereum, becomes almost like the settlement layer. And then the same business logic can now be executed on layer 2 at a fraction of the cost and much faster. So at that point, you can start to see how clearing and netting, or the effect of clearing and netting, can be done on layer 2. Because you are doing very cheap, very fast atomic swaps on layer 2. And then when you want to settle on layer 1, you effectively call in your rolled up transactions and unlock the funds on layer 2. and then layer one. So we're seeing,
Yeah.
for instance, MakerDAO entering into the space with optimism, and giving you ability to now deploy stable coins in layer two. I think that's massive. So I think there is going to be layer two solutions for institutional adoptions increasingly coming up.
Yeah.
It's not obvious to people right now, but once you realize what the technology gives you, it's really, really interesting. The other thing that's, I think, really important for everyone to think through is, the way of you whole DeFi space is the biggest, highly integrated marketplace of financial services and assets the world has ever seen.
Mm-hmm.
And the frictionless nature, with exactly the same wallet, I can borrow, lend, hedge, trade my assets without ever having to worry about, capitalizing various different exchange accounts. So, you have capital efficiency, your onboarding costs are virtually zero. There's no contract maintenance. So it's still early days and still hard to believe that this will take over. But I mean, I use this every day now. I kind of manage my own finances. I'm getting pretty good return on my, I leverage up my loans and all that kind of stuff. And it's frigging amazing. It's just, if you got sizable amounts of money to kind of compensate for the fees, the agility of this network is amazing. And then also from a service provider, one of the issues for me as a custodian, do I want to do clearing and netting integrations with 50 exchanges, or do I want to do one integration with a layer 2 protocol that allows me to tap into every exchange that goes to that? There's only one answer, therefore, that's kind of feels like the future to me, because no one so far failed to dominate the centralized clearing and netting solution on their own. I think there will be really good solutions, but time and time again, anything that's super open kind of tends to win over in this kind of game because of capital efficiency and also kind of service provider costs of integrating.
Yeah. So
interesting dynamics here.
No, this is interesting because everyone gets obsessed, and the amount of times I read real-time settlement or near real-time settlement, but actually it's real-time netting that the market needs, because again, you want to then net settle and there's less overhead, irrespective of whether you're doing it on chain, off chain, delivery versus payment. And so those that talk about near real-time settlement, in especially institutional markets, don't really know what they're talking about. So like I see two ways. Layer 2 protocols, absolutely, it's a really exciting space. The other area, and it'll be interesting to hear Arshad and Sean's view on this, but the other area is at the moment, let's say Sean, you've got borrowing and lending services for Bitcoin, right? And effectively you can put up Bitcoin, take a haircut on that, and then you're lending dollars essentially in the most part, right? That's the market. But more broadly, if you're an institution now, you're taking exposure to Bitcoin, or you've got traditional bonds. I mean, you can't put up traditional forms of collateral beyond, let's say, cash on the digital side. You can't put up bonds. I haven't seen it yet. And then vice versa, you can't put up newer forms of collateral on the traditional side. So, I guess there's a market opportunity there. I mean, how do we solve that? And this raises a point that Alex mentioned, where at the moment everyone's kind of going into these walled gardens, getting exposure. This kind of relates into question to Arshad as well. But frankly, traders don't just trade in one place as much as Alex would like. They don't just custody assets in one place either. So how do you make that exposure and efficiency gain that's needed in this market? Would you have a view on that, Sean? Or a minute now?
It's a fascinating one. I think there's probably three different angles to address it. One is to trade on margin, where you have a single counterparty who just gives you exposure, and you then can net at end of day. And we've started to see the rise of some firms saying that they're prime broker outfits in the crypto asset space, and I think quite a few participants would welcome additional names with bigger balance sheets coming in that. But I think the two angles, one to what Alex was saying on DeFi acting as a multi-hub custodian effectively by nature of the tech allowing transparency completely to see what the counterparty has in terms of collateral. I think that's great. And we're really excited about being able to tap into that ourselves as soon as there's some regulatory blessing to be able to place funds because of the returns you can get being outside of what you can get in the traditional markets. But I think the issue and the reason I think a lot of institutional players are still holding back is the question around what happens if the code goes wrong or if there's a hack. Yeah. Who can we turn to make that good? And it's what I was talking about before on the KYC side. And so I think the third angle that might be kind of the intermediate solution is a multi-hub custody model that allows a tech play. And here I'm thinking of like a Stripe type of thing to connect the various custodians that have emerged, not only as pure play crypto custodians, but also now traditional names coming into the space like Fidelity and Bernie Mellon, and allow traders to access multiple custodians at the same time. And I'd be very keen to see that kind of tech emerge in the market, but curious to see where it evolves.
And Archid, I mean, your model, I guess at the moment, obviously you've got the exchange at the heart of it, and then you'll be launching with the most liquid cryptocurrencies, given that's the initial focus. And then you have your own custodian as well there. Now, do you see a multi-custody model emerging, or what's the play here as far as you're concerned? And again, we mentioned layer 2 protocols in DeFi, but obviously in your region, as far as ADGM goes, that the regulation's not necessarily there, as you'd mentioned. So where do you see all this evolving? Because it's a fascinating region and things can move very fast, as we've seen with regulation there.
Yes, I think it will be a mix of all these things to begin with. So what we will be seeing, the kind of demand that is coming in, and from which kind of investor, and what is their ultimate objective of coming on board and using our facilities. So certain class of investors are just there to buy and sell, and they are like day traders or arbitragers or jobbers who are doing this activity just to make money on tick by tick movement of the prices. Others are there who are like holders or long-time investors, and then they utilize your custody services to park their assets in DeFi applications or in lending and borrowing platforms to earn that kind of returns that everybody is enjoying these days. And then third thing that I see happening is the multi-custody arrangements, whereby if you have an institution moving his assets between different jurisdictions, so that kind of custody play comes in place. But of course, for an exchange like us, where there is a centralized custody, there is a lot of advantages that can be offered to investors who are like first time in this kind of industry. And this industry is very new, and there is a lot of new joiners which are coming on board, and they are not that sophisticated like us, who have very much clean understanding of how they can use these apps, and they can participate in lending and borrowing, or they can go and go on to the layer 2 and can get their assets tokenized and custodized, as well as go on the exchanges and buy and sell or borrow and lend. So I think in the initial days, exchanges like us have a very important role to play to clear that air and bring that kind of sophistication into the minds of the people. Then they can, of course, move to the next layer of sophistication and start utilizing a more decentralized architecture of this whole ecosystem. So I think that's what we are trying to do, whereby we have, to a certain extent, removed the centralized nature of an exchange, where there were intermediaries and there were too much of interference from certain sectors of the businesses. Now everything is technology driven, whether it is identity management or transaction management or even KYC to a certain extent. So everything is technically driven. It's a 24/7 market. You can't expect manual intervention in these kind of things. So we are moving to that scenario where everybody has control on their own things, so that time of transaction can be reduced to as low as possible. But at the same time, there is enough knowledge and there is enough awareness that people don't burn their fingers at the end of the day.
And this is interesting because, again, we've seen more recently now, regulations are going to work against, let's say, crypto trading in India as well. And I guess we'll see directly, indirectly, some of that flow kind of manifest itself in your region, just because of the dynamics that you had. Rupee dollar has been traded on DGCX that you initially set up, for many a year, aside from Singapore. So I think, I see lots of activity in that region, and these players, these newer players, they need that hand-holding. They're not, no, I'd agree with you. I mean, Mike, just on that related point, everyone kind of hyped up security tokens, again 3 years ago, and then beyond that, kind of ICOs 2018 when they kind of reduced in size. But we're still kind of waiting for that kind of real takeoff of security tokens, and some of that, as you rightly said, is some degree of standards and finding your feet. But there has been a degree of cart before the horse here. Obviously, it's an area that I'm very positive on, because we're seeing kind of interesting things emerge. But how do you see it play out? Because the way that I see it, everyone gets really excited about, yes, I'm going to tokenize a bond and put it on a corporate bond and put it on the blockchain. But there's no magic wand here, because an illiquid bond is still an illiquid bond, right? So how do we get traction there, both in terms of primary issuance investors, and then also harness secondary liquidity in something that traders will find interesting? Because in a liquid bond, there's no hedging or arbitrage market of note, really, or it's limited by any degree.
Yeah, so I think it's an interesting marketplace. I think it's been slowed down to an extent because of the pandemic. I think things would have accelerated faster, albeit on a primary issuance side, you can't go out and do the road shows and raise the capital, which follow the traditional methods. So, but I do think what we're starting to see is the access to potentially some form of security tokens that don't necessarily take the common traditional standards of just a straight equity issuance. And right. At the same time, I think what you're also seeing is that bond issuances, they all trade OTC, and they tend to be for a minimum large denomination of $50,000 upwards. Mm-hmm. So if you can fractionalize those bonds, or even just have lower units on those and trade it through an exchange, I don't see why we can't give far wider access to capital markets. And we are talking to governments about potentially, one of the things we're looking at, just to demonstrate what we're potentially looking to do, we haven't signed anything, is that there is a government that, because of the pandemic, they've run out of capital. So they're paying their government workers with retail bonds that can only be cashed in at the central bank. But there is no kind of proper liquidity to this. The access to the central bank is not very accessible. And we're looking at how we can potentially put it onto a platform, on our platform, so that we can give international investors potentially exposure to government bonds, and it gives the retail public who own these bonds, or the workers, the government workers, the ability to potentially sell their units. So I think that can help create greater liquidity if we can get the central bank then to act as the person of last resort, in terms of that they will always make a price in it, so that they will make the market regardless. But the other thing that we're looking at is how can we deal with some of the kind of more slightly esoteric industry. So NFTs have gone completely nuts over the last 2-3 weeks, just crazy. So we could look at how we can fractionalize NFTs in the same way that you can fractionalize a property, the Shard in London, or the Burj in Dubai. How you can actually, or a painting. So how can you give access to a wider group of audience access to products? So the other thing we're looking at doing is how we can work closer with influencers. So how we can monetize and securitize some of those influencers, and therefore you have a more of a mass market that you can appeal to, whether they're investing in, say, a royalty token where they get some residual value from in perpetuity, so different to a bond. And I also think that sometimes some of the actual capital markets as they exist today are not necessarily as fit for purpose for what would be tomorrow. So, for example, with the pandemic, we're looking at how we can create what we call a royalty token, which in effect is a preference share that gives someone the ability to have a certain right to the economics, whether it's profits or revenue of a business in perpetuity. So if you go through another pandemic and there's a sudden slump and the business falls away, you're not in risk of default, which many of these bonds have been. So I think if you can do that for a mass market, which is why we want to be financially inclusive. So someone in Venezuela who are going through torrid times and maybe paying people on, by and large, through things like Bitcoin at the moment, if you give them exposure to securities in say New York or London or wherever it ends up being, then in terms of financial security, I think it would be a lot better. And because you're hopefully appealing to more of a mass market, it will in turn create a greater liquidity. But I think it's very retail driven to start off with. I think it's meant to be in terms of the security token market. And I think once the retail adopts it, I think it'll be like Bitcoin. You'll start seeing the institutions come into play. But I think it's important to also note that on most stock exchanges throughout the world, you get the top 20 to 25% is fairly active. The next 25% is relatively inactive, and the bottom 50% are zombies. So you're not suddenly going to wave a magic wand and create huge liquidity. But I think if you have mass appeal to a wider audience, I think you can create greater liquidity. And obviously you can have market making facilities and stuff on top of it.
Yeah, and also we've found with some of what we're doing, a portfolio-based approach, with a broader range of similar assets kind of packaged together is certainly interesting. Just one thing there, because, you'd mentioned SMEs, but Sean, you'd mentioned SMEs as well. Then, at the moment, some of these kind of investment platforms, whether it's, security token platforms, are talking about, raising capital for SMEs on equity and debt. Obviously, there as a future regulated bank, it's something that you're passionate about. But again, for the audience's benefit, sometimes some people struggle with, well, how can digital assets democratize access in terms of SME finance and lending? I mean, could you just talk to that point, because I think it's interesting.
Yeah, I think one thing that's been really powerful has been the rise of the crowdfunding or crowd lending platforms as a sign of what could be possible if we look at the technology and opening up access to capital. And here we've seen that there is demand from retail for access to startup companies or SMEs that are looking to raise equity or debt funding. I think the real push though will happen when more institutional investors think that this is a viable means to access a new asset class. And here I was intrigued by the previous panel and the discussion around looking at just the sheer numbers. If an institutional investor invests in 1,000 small companies, they will have probably a good, based on portfolio analysis, return across the portfolio. But in terms of the mechanics of delivering that, and here I'm particularly keen in digital debt, because I think the cost to issue a bond is for an SME prohibitive, being a couple $100,000 when it considers legal fees, structuring fees, underwriting fees, and the whole gamut of costs. And if we look to digitize that whole process and strip out the variability between different SMEs in raising debt capital and offer a simple digital instrument, that could become theoretically tens of thousands. And there are some firms who are already, thankfully, looking to structure that process. And that's a game changer. If an SME can think that they can raise the $1 million that they need to build a widget or the next factory in a way that is much more capital efficient for them, there will be then supply of good companies looking to give. But they will only, I think, tip that balance when there is that institutional interest. And I think I would just differ slightly with Mike. I think retail will probably drive it, but we're not going to see the real flow until there is institutional interest in investing as well.
Yeah, no, I'd agree with that, and it's interesting because you know, with some of what we're doing, and you know, Mike has seen this as well. You know, the cost of creating bonds or other forms of instruments has fallen dramatically because, again, you're using technology to automate that and standardizing a legal process, you know, or sponsorship or whatever model that can be that can be quite cumbersome. So you're kind of rationalizing a lot of that. But the other interesting thing is, you know, for these types of loan products as well, and you know, I've been reading up on it as far as the US is concerned as well, because you know what the implications of DeFi, you know, vis-a-vis some of the issues that some have fallen into with, not to name names, on security token issuance that you know they thought wasn't a security at the time, but actually you can structure these instruments so that they're not securities at all, as you intimate, Sean, and you know, that to me is very, very interesting, because even when the banks are taking on loans, I mean, there's a limited secondary market for these types of instruments, right? You know, they'll underwrite it and then they'll write them off. But you know, we're beginning to see opportunity in some of those asset classes for sure. And then, you know, just going back to you, Alex, I mean, when you originally set up what you're doing, you know, a lot of the focus was on, yeah, you know, yes, we can custody assets securely, we can insure them if you want, you know, again, if you move them into an exchange, you know, we can track the assets effectively. But now, are you getting increasingly approached by your customers to say, well, you know, can you offer us more? You know, we're looking at you know, not paying you, we're looking at earning interest on this, and you know, how do you counter that? You know, as the big boys come in, you know that there's a multitude of services that can, you know, where one can cross subsidize the other. So, you know, how as a kind of really innovative smaller player that has a good kind of franchise, can you counter that?
Yeah, sure. I guess we're seeing two trends right now. More and more folks, like brokers, starting to accept crypto deposits and withdrawals. So, you know, we're starting to see folks coming to us and saying, can you support 200,000 keys for all of our customers, because we need to manage deposits? And the good answer is yes. So they kind of can very quickly enable effectively almost like a, you know, payments infrastructure, but also the kind of the ability to reference who's paid them when, and manage all that kind of funds flow. So that's great. On the other hand, kind of as you alluded to, what people really want is the utility from the tokens. So we're now moving towards yield bearing, hedging, lending, borrowing. And again, this is where I get super excited about both the centralized services, and actually I think there's huge amount of, you know, benefits there, and we very much integrate with those, but also decentralized, because the old custodian model is you give your asset to the custodian and hope that the custodian can do X, Y, Z with them. But the new model, which is what we're working on, is we don't ultimately custody keys. So we ultimately custody keys, not assets. Yeah.
Yes.
And that's a really fundamentally important difference, because we do not we cannot under the hood rehypothecate the assets, because we only do the transactions that you tell us to do. So we can prove to you that we are super clean because of the transparency that Sean talked about. So, but then the next thing is, if you give it to the custodian doesn't support Aave or Compound or whatever else, then you're stuck. The utility of those assets is much less. Yeah. But because what we do is we effectively safeguard the keys and then manage the transaction permissions, assets within our custody are infinitely usable, or we have zero reduction in the utility of an asset that's held with us, because we frankly just make sure that we keep the keys safe, and then if you want additional controls on how you transact, we enable those things, but we never get in the way. And I think this is a fundamental shift in custody for crypto assets, because the old custodians, they had to do asset servicing, but there is no asset servicing because code services the asset. So what's left to the custodian? And what's left to the custodian is key and transaction management, which is what we do. The other
There's a
issue
common.
that we're seeing now, and this is really important. I think I'll just, sorry to interject.
Yeah.
Where I do see still kind of a lot of opportunity where custodians can add value is under collateralized loans. Because as soon as you move into under collateralization, you need to know the entire portfolio as well as the individual. And the only kind of trusted source you then end up having is a custodian who can say they genuinely have those keys and those assets. And I can run you a risk model, give that to Sean, and you can lend on a preferential basis. And that's what we're working with guys like X Margin on, precisely that, to make sure that we provide under-collateralized loans to those people who need. And I think that's an interesting angle there as well.
No, it's a great area, and I know we're running out of time, but the common theme there, actually, when we talk about layer 2 protocols, hub models that Sean mentioned, and as you mentioned now, key management, then opening up a multitude of services. Again, what Mike mentioned cross-jurisdictionally, and then what Arshad mentioned in terms of opening up a wider range of customers. Again, this is where I see a lot of the action is, that middle ground, because we've had the first wave where some of these walled garden exchanges have built good ecosystems and they continue to augment them. But I honestly think, and I think this resonates from this panel, that the next wave is going to be much more collaborative because different folk, I mean, even all of you are doing very different things. And actually, when you overlay all of that, it provides for a much wider service. The banks kind of built that up over decades, and they've got a part to play here as well. But for newer players, competition and synergy in terms of services and that network effect is absolutely key. So on that note, it's been an absolute pleasure. And all of you have come up with some really exciting points, and I look forward to following them up individually as we work together. Thanks very much.
Thanks, guys.
Take care. Have a good day. And thank you
Enjoyed
everyone
it.
for listening. Take
Good.
care.